Investing can feel super complicated, right? Like it's some secret club reserved only for the experts. But what if I told you there's a key, a really simple one, that has opened that door for millions of people? Today, we're going to demystify one of the most powerful and popular tools out there. I mean, think about it. How can you possibly own a piece of Apple and Microsoft and Amazon and hundreds of other huge companies all at the same time with just one click? It sounds a little too good to be true, doesn't it? Well, that's the exact puzzle we're going to solve. And the answer is something called an exchange-traded fund, or ETF for short. Honestly, the easiest way to picture it is like a shopping basket. Instead of walking down every single aisle of the stock market picking out individual items one by one, you just buy a pre-filled basket. That's it. One simple transaction.
Okay, so once you decide you want to buy a basket, you've got a really important choice to make. It basically comes down to two totally different philosophies for how that basket gets filled. This is what we call the great divide between passive and active ETFs. So on one side, you have passive ETFs. Their goal is super simple. Just match the performance of a specific market list, which is called an index. It's all automated, which means the fees are ridiculously low. Then on the other side, you have active ETFs. Here, there's a fund manager behind the wheel, constantly buying and selling, trying to beat the market. And because it's so hands-on, well, you're going to pay more for it. So what exactly is this index that passive funds are trying to copy? Just think of it like a sports league leaderboard. The best teams rise to the top, and the weaker ones slide down or even get kicked out of the league. An index, like the famous S&P 500, does the exact same thing, but for companies. It's just a constantly updated list of the strongest players. And because that whole passive strategy is just following a list, it's automated, the management fee, which is called the expense ratio, can be just shockingly low. I mean, we are talking about numbers as tiny as this, 0.05%. So what does that tiny little percentage actually mean for your wallet? Well, if you invest $1,000, you're only paying about 50 cents a year for the fund to do all the work. It's all handled behind the scenes, so you never even get a bill for it. It's pretty incredible. And this quote really sums up the whole trade-off perfectly. The idea of having a pro manager trying to beat the market sounds amazing. But the reality is, you pay them more for that attempt, and there is absolutely no guarantee they'll actually do any better than a simple, cheap index fund over the long run. So once you wrap your head around that simple, low-cost, passive idea, a whole world of possibilities just opens right up. Now you get to choose which market, or which league, if we're sticking with that analogy, you want to get into. You want to own the biggest companies in the US? Yep, there's a basket for that. More interested in established markets like in Europe or Japan? There's a basket for that too. You could even pick a basket full of companies from fast-growing places like India or Brazil, or one that focuses only on smaller companies that have huge potential to grow. And this is the real magic of it all. Instant diversification. The moment you buy an ETF that tracks the S&P 500, you are instantly invested in all these different industries. You're not just avoiding putting all your eggs in one basket, you're basically buying hundreds of different baskets all at once. Now, you've got to remember, investing is a marathon, not a sprint. The journey is not always a smooth, straight line up. You're going to have good years and bad years. That's totally normal. The key thing to see here is that the overall trend, over many, many years, has consistently pointed up. In fact, when you zoom out and look at the big picture, even with all those inevitable bumps along the way, the historical average return for a big market index like the S&P 500 has been somewhere around 8 to 10% a year. That's the power of staying in the game for the long haul. Okay, let's talk about another great benefit: getting paid. A lot of the companies in your ETF basket actually share their profits with you. These little payments are called dividends, and you actually get to choose what happens with that money. So you've got two main choices. A distributing ETF will pay those dividends directly to you as cash in your account, which is great if you want some regular income. But an accumulating ETF automatically takes that money and reinvests it for you, buying you more of the fund. This kicks off that amazing snowball effect called compounding, which can seriously accelerate your growth over time. And here's a little pro tip, so listen up. Depending on where you live, accumulating ETFs can actually be way more tax efficient. See, because you never technically receive the cash, some tax systems don't count it as taxable income right away. It's definitely something you'll want to look into based on your own country's tax laws. So, you get the basics, you know the options. How do you actually get started? And maybe just as important, what are the big mistakes you need to make sure you avoid?
Well, the first few steps are pretty straightforward. First, you'll need to open a brokerage account. That's just where you buy and sell investments. Then, take a minute to define your goals. Why are you investing? For retirement? A house? And finally, be really honest with yourself about your risk tolerance. How would you really feel if your investment dropped by 20%? Answering that stuff first will guide all your choices.
Now for the big don'ts. And please, really listen to these. Do not chase after a fund just because it did great last year. Past performance is no guarantee of anything. Don't you dare ignore those fees we talked about. Don't put all your money into one trendy little sector. And most of all, if you don't understand what an ETF invests in, just don't buy it. Find a simpler one.
And I really want to hammer this point home one last time about fees. Look, a 1% fee doesn't sound like a lot, but over 20, 30, or 40 years of investing, that tiny 1% can eat up a massive chunk of your potential money. Seriously, always check the expense ratio. So there you have it. You now have the fundamental building blocks for taking your financial future into your own hands. They are simple, they are powerful, and they are low cost. So the only question left is, now that you know how to use them, what are you going to build?